Imagine you're building an impenetrable fortress to guard billions of dollars. You pour concrete, you hire armed guards, you install these state-of-the-art laser grids. From the outside, it looks completely flawless. But then you realize someone left the back door propped open with, like, a cheap wooden wedge. Welcome to our deep dive into the July 31st, 2026 Bitcoin landscape. Our analytical mission for you today is unpacking the intense institutionalization and diversification of the ecosystem. Okay, let's unpack this.
Yeah, I love that analogy because we're looking at a market pulling in two very extreme directions right now. On the surface, the spot price is just incredibly tightly wound, glued right near the 63,700 mark.
Right, bouncing in a tiny range, like between 63,549 and 65,340?
Exactly. But underneath that calm surface, the derivatives market is heavily fortifying. I mean, CME futures open interest just hit a 2-month peak, and the put-call implied volatility skew is sitting in the 80th to 91st percentile.
Which is wild. And, for anyone not staring at derivatives charts all day, that extreme put skew means Wall Street is aggressively buying up downside protection. They're basically bracing for impact.
What's fascinating here is how institutions are utilizing these derivatives specifically for capital preservation. They're building a defensive moat. And to fortify that moat, the Chicago Mercantile Exchange is rolling out 24/7 trading for futures and options in early 2026.
Wow. Going fully 24/7 is a huge structural shift. It finally fixes that glaring duration mismatch between crypto's continuous spot markets and standard legacy trading hours.
Yeah, they clearly want bulletproof financial infrastructure.
Yeah.
Which honestly makes this next development completely jarring.
Oh, you mean the hardware failure?
Yeah. While institutions are building that flawless financial fortress, we just witnessed a catastrophic failure in physical security on the individual level. A Coldcard firmware bug allowed attackers to drain about $38.3 million.
Wait, that was across like 500 single signature addresses, right?
Yeah, exactly. Almost 600 Bitcoin just gone. Because the hardware supply chain and firmware testing simply haven't kept pace with the asset's explosive valuation. The device's true random number generator essentially failed.
Right. And a true random number generator relies on unpredictable physical noise to create security keys. But when it failed, the devices silently defaulted to a software-based pseudo-random number generator.
Right. The software just started using something predictable, like the device's date and time, to create passwords. It drastically reduced the entropy, making those cryptographic seeds totally predictable.
I mean, it's like replacing a bank vault's titanium combination lock with a cheap plastic diary padlock. You've got this massive vault, but the lock is a toy. And I have to push back here. If Wall Street is pouring billions into this space and demanding institutional-grade security, how are we still relying on fundamental self-custody flaws like this?
Well, institutional custody uses entirely different distributed setups, whereas individual self-custody is still battling these hyper-manual critical bugs. For users caught in this exploit, the required fix is immediate but highly manual.
Yeah, what do they even have to do?
You have to update the device firmware, generate an entirely new seed phrase, strictly verify the wallet fingerprint, and execute a test transaction before you even think about migrating any funds.
What a harsh contrast. Individual self-custody is battling these hyper-manual bugs, while Wall Street is fully automating their regulatory moats. Like, look at the SEC just approving a 15% net asset value buffer for the SIBO BZX exchange.
Right. By giving ETFs that buffer room to write options against their holdings without blowing up their tracking, they've legally paved the way for yield-generating Bitcoin ETFs.
And the capital is swarming. I mean, BlackRock's IBIT just absorbed over $183 million of a $233 million net daily inflow. So what does this all mean?
It means the corporate layer built on top of the network is permanently fracturing into distinct strategies. Take MicroStrategy, for example. They're playing the ultimate maximalist treasury game, holding nearly 844,000 Bitcoin.
But to maintain that pure treasury strategy, they are willingly sitting on an $8.3 billion non-cash unrealized loss. That scale is just absurd.
It really is an extreme bet on the asset itself. But contrast that with Coinbase, who is pivoting entirely. They reported 88% of their Q2 net revenue came from non-spot trading.
Wow, 88%.
Yeah. Their subscriptions and services division alone brought in over $555 million. Trading fees are volatile, but subscription revenue is stable. And, miners are following that exact same logic.
Because the halving crushed mining margins, right?
Exactly. So Applied Digital pivoted their computing power, making over $203 million from AI hosting this past quarter, compared to just $37 million from their legacy crypto operations.
And because these miners are shutting down crypto rigs to chase AI profits, there's obviously less computing power on the Bitcoin network, which directly triggers a mathematical response. On August 8th, the network faces an estimated 2.44% downward difficulty adjustment just to compensate for those shifting economics.
Yeah, the foundational layer automatically adapts, while the corporate layers above it completely transform.
Which leaves you with a critical question to ponder. If mining firms are pivoting to AI data centers and Wall Street is successfully wrapping Bitcoin into traditional yield-bearing ETFs, will Bitcoin's future rely more on legacy financial plumbing than the cypherpunk blockchain itself? We've built an incredible financial fortress, but we might just be trading out the laser grids for the very legacy vaults this technology was meant to replace.